Well, Vishwavir Ahuja would also likely be optimistic. The numbers met street estimates. Let's get in. The management. Samit Sarkar, of course, caught up with Mr. Ahuja and begin by asking him about the factors behind the strong quarterly performance. Listen in.
The momentum in the business has been strong across the year, actually, and across several years now. In our 7-year journey, we've actually grown 40 times in size and more than 50 times in profitability. So, just to set the context. In this current year, yes, indeed, we grew across the board, on the average over 40%. And all our businesses, which is the large corporate business, the commercial banking business, which is the mid-market and the SME business, and then the various components of our non-wholesale businesses, namely the financial inclusion microbanking business, the card business, the LAP business, and some personal lending businesses that we do. So these are the various 6 components, if I may put it that way. And all of them experienced very strong growth. At the same time, businesses grew in a very solid and prudential manner. In other words, as you mentioned, asset quality was also well maintained and in fact improved. And margins reached an all-time high this time around. So there are, of course, several factors, why this has been happening and why that momentum should even continue in the future.
So you expect this momentum to continue in future, and what is the kind of loan book growth and the net profit growth that you're expecting for the financial year 2019? So
in mid-2016, just prior to our IPO, we put out a sort of a 4-year, guidance, let me put it that way, or rather a guide path to 2020, where we had suggested certain financial metrics, and we are actually tracking very well to those metrics. And we are kind of at the halfway stage right now, and where we are indicated that the growth in the businesses will be tracking to 30 to 35%. The ROAs and ROEs will also improve consistently. Cost-income ratio, which was at that time close to 59%, by 2020 will come down to 51, 52%. And CASA will also improve year on year. So actually, if you track to that guide path, we've actually achieved and exceeded on all financial metrics. Now that 2 more financial years are remaining to that, we are very confident that we will be able to track to the guide path even in the next 2 years. And if I may break down what I meant, is that the 30-35% growth guidance remains. The improvement in margins, which is now almost touching 4% in terms of NIMs, we are sort of happy there, but it may further improve a few basis points. And ROE and ROA expansion will continue to happen. And the efficiencies in the business, now that many businesses are at reaching good levels of scale. So both combinations of economies of scale, efficiencies, better cost of funds, better asset mix, and therefore healthy yields, all will lead to these kind of outcomes.
On the cost side, where do you see your credit cost to be in financial year 2019? I assume in financial year 2018 it was close to 95 basis points.
That's right, it was 96 basis points. Now there are the so-called regular costs of doing business, and then there was a one-off effect that we experienced post-demonetization on our then microbanking book. So if I was to remove that is about 18-19 basis points. If I remove that, the rest of the business is operating just under 80 basis points of credit costs. We expect that to come down further. It has come down, it will come down further. As far as that business is concerned, on that book, the provisions had to be taken in March 18 and March 19. So the March 18 provisions were taken, some balance provisions have to be taken in the current year. So if I strip that out, then we are actually seeing credit costs come down to even below this number.
On the gross NPA side now, for the agri segment, it has risen to around 4.15% versus 2.89% in the last quarter. Do you still remain cautious on the agri side, and when do you expect the agri segment stress to stabilize?
So the agri, how we tackled it, the fact is that there is stress in the agri segment. And there are multiple external factors for that. And those have not gone away or going away. So at the end of the day, now we really need to see how we need to deal with that business. So the first thing we did was to tighten that business itself. Also in terms of proportion, we brought it down from 7% to less than 5%. So it's a much smaller, if I may say, base of business. Then we broke that business down into what is more corporate type, linked to the corporate, where there are corporate linkages, and some which are pure retail farmer-led. So we've separated them. And now the corporate type will sort of be handled under the commercial banking umbrella, and the retail type will go towards the retail side. So I think with passage of time, this portfolio will be tightened, and we don't expect it to worsen much from where it is, at the end of the day. And just in terms of sheer materiality, the materiality of that is actually going down more and more.
So what were the slippages during the quarter? And there was also one corporate banking account which was expected to be resolved in the fourth quarter of financial year 2018. So has that happened?
Yes, it did. Firstly, the slippages have been coming down, and they have come down even in this quarter. So, that's the straight answer to that. And that one corporate account was actually resolved as per our indication. Yeah, and therefore, that is no longer, if I may say, an impaired account. It's a standard account.
So RBL Bank's exposure to the power sector is closer on 4.3%. Now Axis Bank, we saw they saw huge slippages because of the power sector account, and they say that around 40% of the power loans are now NPA. What has been the experience with RBL Bank when it comes to the power sector?
So our sectoral exposures are not because we decide to lend in a particular sector. These are corporate linked. In the case or cases that you're talking about, these are all very high investment grade A+ rated companies. So actually speaking, and these exposures are not necessarily linked to project. Yeah, these are, maybe we are giving them sort of working capital loan or part of their banking group from that sense in terms of their ongoing business requirements. So these are very healthy exposures when you look at the underlying asset quality. So actually we have no concerns as far as our so-called power sector exposure is concerned. They're all performing, they're all standard.
Lastly, on the inorganic growth opportunities that you are looking, which are the areas of interest for the inorganic growth perspective that you have?
So I want to be very clear that we have no inorganic plans, on the table or on the horizon. Yeah, I think we are seeing such good growth momentum in our various businesses. And if I may take a minute to clarify, the retail businesses, which is the card business, the financial inclusion business. For instance, the financial inclusion business, just in the last 12 or 15 months, today has been growing at close to 60% per annum. And today our total portfolio, 90% is the new business we've done post demonetization. And that is operating at, less than 30 basis points of NPA, or 99.7% collection rates. So it's a very good, high quality, fast growing business. The card itself, has been a great, if I may say, offering from the bank. Today we've reached the sort of top 5 banks in the country in card acquisition and in card spends. So there is a lot of growth momentum sitting in these businesses. And our other businesses, even on the wholesale side, are growing well. On the wholesale side, we are seeing some opportunity in the next 12-18 months emanating from the challenges of some other banks in that space. So there is some opportunity to get some market share there. So what I'm trying to say is that rather than getting distracted, there is enough opportunity to extract, in our existing range of businesses.
Just on your market share point, I would like to understand what is the current market share and where do you see it 2 years down the line?
So our market share is very small. I mean, taken together, we are a 40,000 crore advances bank. And so it is obviously in basis points as far as the entire industry is concerned. So I think that stage where we start measuring market share is a bit away. Yeah. And right now, I think our focus is to ensure that we consistently grow, handsomely, we grow prudentially, we grow sensibly, and we grow profitably to make sure we reach a certain size and scale in a few years when actually the so-called market share question will start getting more relevant.